Here's how the stock market has performed based on what year it is in the 4-year election cycle. I went back to 1871 and bucketed together each of the 4 years' returns for the S&P 500. Let's take a deep dive into the findings and talk about what you can do as an investor. Let's do this. Hi, I'm Christoph Marzik. I've been a professional trader and investor for almost 20 years, and I have a mission to empower you to make better trading and investing decisions. Here we go, the deep dive of the stock market election cycle. So what I did, bucketed each one of the 4 years, right? You got post-election year, midterm election year, pre-election year, and the election year. It's clear that the pre-election year and election year are outliers, okay? We can make some assumptions about that. Does it have to do maybe politically a little bit, that the politicians don't want it to have, nobody wants to go into a weak market ahead of an election. That would be detrimental to their chances of success, right? So maybe they do a couple little more influences on the stock market? Potentially. I'm not here to speculate too much on that, but I'm just here to show you the data, okay? The midterm year, and this is filmed in 2026, that's this year, is sort of the obvious outlier to the downside, right? Lowest median returns, which, by the way, median means I just took the middle number of the returns, okay? I didn't take the average. Averages can sometimes be skewed, but for the sake of science a little bit here, or data, I use both numbers. And the positive years are also not as juicy as the other ones. Now, granted, something to note here, and we'll talk about this next, is the odds of a positive year any year is pretty good, right? We're talking, I don't know what the average of this would be, in the 70s, 70 percentile for sure. And the returns, okay, average returns also, I mean, you're going to make money long term in the stock market. That's the general synopsis. And if you feel like things are overheated now, which, by the way, I can make an argument. I probably will make some arguments as to why I also think they're overheated. Valuations are through the roof. Complacency is high. And we're still ripping up higher. So is there a chance we have a short-term correction? Of course. Nothing on here is 100%. Okay, nothing on here is 100%. But long-term, you're probably good. And short-term, I don't know if I would bet against this next year, okay? Or the next 2 years, frankly. That doesn't look like something I would bet against. All right, so that's the general findings since 1871. The general things you can take this information with. First of all, do what you will with it, okay? You can make your decisions. Like I said, nothing's 100%. I want you looking back on this video in a year and a half being like, Christoph, you said 87%. I was supposed to get 12% returns. I didn't get it. I don't know the future. Nobody knows the future. But long term, you could probably count on something similar to this, okay? All right, well, I hope you found this super interesting. I certainly did. And on my next video, I'm going to be going through how I collected this data and made these tables in the first place. And honestly, I'd entertain you to come and join that video and just give me an audit. See if you see anything that I did wrong. I'm going to compare my results to another YouTube channel's results, and we'll go from there. So I hope to see you there. Thanks.